Hi, everyone. This is Jason Barrick of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. They are ahead of the curve on energy, finance, and the economy at large. I like interviewing them every 3 or 4 months to get their insights on what they think is going to happen next over the next couple months. Doomberg, thank you for joining me again.
Hey, Jason, good to be back with you.
So, Doomberg, we're recording this interview on Monday, April 24th, 2023. You put out a piece at the end of March on regional banks, and I think the Fed, the regulators here in the United States, the Treasury Department, it seems like they're trying to just sweep things under the rug, telling people that, look, we averted this regional bank crisis, even though interest rates are high and the Fed may continue to raise them. Do you think that the regional banking crisis here in the United States has just started, though?
I would say that we are at an important moment, as we're talking, FRC, First Republic, is looking to report earnings here, and it probably happened as we're recording this. That would be a pretty interesting insight into how effective the Fed has been at assuaging any panic in the market. The piece you referenced, which we published on March 30th, was called Regional Fallout. And I was thinking about, Wall Street for Main Street is the title of your podcast. And really what our big concern is when we wrote that piece was the impact on Main Street banks. The Wall Street banks, the too big to fail banks, make money because they're too big to fail. Everybody knows they sort of have a put, and that allows them to harvest huge amounts of deposits and pay next to nothing on those deposits and make their money in a variety of ways. The Main Street banks actually do the hard work of lending to small businesses, small construction companies, commercial real estate, makes up anywhere between 50 to 55% of sort of U.S. economic activity. They're a key part of it. And in a world where, FDIC insurance levels only apply to small banks and big banks have a wink, put option on deposits, then, when small banks lose deposits, they stop lending. And when small banks stop lending, the economy goes into a bit of a crunch. And so that was the main thrust of the piece. But as we say, it's a pretty fast-moving story, and I do think we're going to get a pretty severe test here in the coming days as to how well the Fed is doing. And of course, to be totally fair, deposit outflows out of banks are not just affecting the small banks. The big banks are losing deposits as well, as the chasm between what you can get in a savings account at a bank and what you can get at Treasury Direct or a money market fund is persistently wide. I think the initial trot on the bank that we saw with the mostly crypto-related banks is causing a rethink amongst sort of money managers and treasury departments of small and medium businesses around the country. Hey, why am I sitting at a bank when getting 0.5% or 1% when I could go into a money market fund and get 4%? And so it is a very fascinating time. Time will tell, especially in the next few days, I think, how this will all shake out.
Well, I think it's going to take longer than that because I'm seeing estimates out there from banking analysts. There was a Bloomberg article on this about how the regional banks are holding approximately $800 billion in losses on bonds. Now, if that's true, at some point they're going to need to go raise capital to fix their balance sheet, especially if depositor funds are leaving the bank. So I think that's what got some of these other banks like Silicon Valley and others in trouble is depositors were leaving. They had losses on some of their bond or loan portfolio. They mark to market those losses, which the large too big to fail banks don't have to mark everything to market. And so the smaller banks, when they have balance sheet problems, they have to go raise equity capital. And that just is basically a vicious cycle where if the regional banks need to go raise funds or they have depositor funds leaving, they have to go raise capital. But in this environment, it's not really good for raising capital for a smaller bank.
Yeah, I would say to the extent that interest rates have come back in, at least market-based interest rates have sort of come down a bit since the apex of the initial crisis. That does fix some of the balance sheet damage that you correctly allude to. But the majority of that mark-to-market loss that you reference is sitting in the too big to fail banks, right? And so in a world where there's a deposit run at JP Morgan, we have much bigger problems to worry about in our view. It doesn't change the fact that, yes, for individual banks, as you correctly articulated, they have far fewer options for liquidity. Although the new Fed program where you could pledge these things at par and, pay a hefty interest rate penalty, as long as you're not undergoing a run on the bank, I do think that most of these smaller regional banks could muddle through, might take a hit to earnings and so on, which itself could lead to a doom loop. It is certainly an evolving situation.
You don't think that program is a bailout? Because it seems to me, Doomberg, that the Fed
it's a bailout. Yeah, for sure. It's a bailout. Sorry, go ahead. Finish your question.
Oh, I was just going to talk about the 2019 repo crisis at Jerome Powell. His speeches from August, September, October 2019 were very similar to what they've been saying now, that it wasn't QE, that they were loaning against collateral. But what happened during the repo crisis was they just kept extending the loans. So the loans went from overnight to about a week and then a couple weeks, and then they just kept extending the loans. And what now the loans that they're loaning at par value for stuff that's probably worth at least 70 cents on the dollar or less at this point, and they're loaning it at par value. What they're supposed to be, the loans are supposed to be paid back in 12 months, but I think the Fed's just going to keep extending and pretending on those loans.
Yeah, and so to the extent that you're betting on a crisis, you're trading against the Fed. I mean, again, we've long said when forced to choose between going over the ledge and into the abyss and or breaking the law, really, to be more extreme about it, the Fed will always choose to break the law. And, this is why they just decided they could buy corporate bonds, even though they had no statutory right to do so. Or I guess more accurately, they bent dubious statutory language in order to claim that they had legal authority to buy corporate bonds during the height of the COVID crisis. And but by doing so, it can be argued, and I think correctly so, that they did stem a panic, and that ultimately that action was, net beneficial to society when taken in isolation. But yeah, just to give you some numbers, because as we were talking, of course, First Republic reported, they ended the period with 105 billion in deposits versus an estimate of 137, and that seems to be a confirmation that the outflow was a little bit more pronounced than perhaps we've been led to believe. So we'll see how the stock reacts, and more importantly, how deposit holders at other similar institutions react in the coming days and weeks and months. But I just wanted to close the loop that they've in fact reported, and my Bloomberg terminal is filled with red bolded headlines there.
So you said that the large too big to fail banks here in the United States have larger commercial real estate loan books, but on a percentage basis, don't the regional banks, some of them have 60, 70% of their loan book is commercial real estate.
Yeah, you misheard me. No, I did. The commercial real estate is in fact embedded in the smaller regional banks, as you correctly just said. And I thought that's what I said earlier. So if you misheard me, I apologize. Yeah.
So for our listeners out there, actually, it's kind of, you have to look at it. So in total dollar amounts of loans, the larger banks have more commercial real estate exposure, but as a percentage of their total different loans, different types of trades, it's smaller. So in terms of direct exposure, percentage of the loan book, the regional banks have way larger exposure to commercial real estate, whereas the too big to fail banks, they have total volume size, but it's not like 50, 60, 70% of their loan book.
And I would also say the read through to economic activity is more pronounced with the small banks as well. I mean, because a lot of these loans are for, small business development in areas of the country where the big banks just don't participate. And as you know, small businesses employ an awful lot of people in the country, and access to banking and lines of credit are absolutely critical to their economic performance. And this really does come down to personal relationship between banker and owner, which just doesn't exist unless you're worth, 100, 200 million or more at the big banks. And so, yeah, I do think that I don't think there are very few people who would argue the critical role smaller regional banks play in the operation of the U.S. economy, its economic growth, and the economic prosperity of the average U.S. citizen. And to the extent that our federal banking overlords flub their way to a point where they're inadvertently perhaps convincing people that they need to remove their deposits from these banks, the second and third and fourth order consequences of that political ineptitude will be felt by everybody.
Now, we saw about 6 weeks ago, we saw Janet Yellen, the banking regulators, they were flip-flopping back and forth all the time about what's going to be covered for people's bank accounts for the FDIC. At one point, it was discussed, there were numbers like 500,000, then 750,000 that was going to be covered for FDIC. Even unlimited was being talked about there. Do you think that the people in power are just going to continue to play fast and loose with that? I mean, I'm not even sure what the real number is now post Silicon Valley Bank about what's going to actually be covered by the FDIC, because of all the different numbers being floated around. And it seems that the people in power, the bank regulators and people in DC, keep changing their minds.
Yeah, I would take a meta view of the situation. Banking is nothing if not foundationally, um, ultimately dependent on confidence, right? And to the extent that the flip-flopping and sort of chaotic and random nature of the official response to the sort of mini crisis that we experienced a month and a half ago, um, that gives the impression that the people in control don't quite know what they're doing, which by definition strikes at the confidence which is so necessary to keep the whole edifice intact. And ultimately, we don't doubt for an instant that before they would let the financial world go over the edge into the abyss, as we said earlier, they would just blanket insure all deposits, even if they don't have really legal or financial means to do so, which would be the sort of the ultimate bluff. But I do think that the biggest risk of Janet Yellen's performance in Congress, et cetera, is the damage it does to the confidence in the underlying scheme, and the increasing potential for a true financial contagion that actually, as I'm sure you know, we've been kind of faking it until we make it since the global financial crisis. Like, I mean, ultimately, in the absence of confidence in the fact that, quote, the Fed will just take care of everything, a lot of things that necessarily might not take care of themselves suddenly become in play again.
Well, now that we have 12 months of interest rate increases, I think now the lag effect, the damage is finally starting to increase and being magnified. Looks like, Doomberg, that the main crisis here is going to be in commercial real estate, and whether or not these regional banks fail or not, I think is we'll see what happens with bailouts or which banks have depositor funds being taken out very quickly. It looks like First Republic seems to be one of the major ones, as you said. What, 30 billion, another 30 billion drop in depositor funds. I wonder if they're going to make the large banks continue to put cash into those things.
Yeah, I don't even know if those the deposits include Jamie Dimon's check that he wrote or not. It's kind of a fast-moving situation, and just the stock has been trading wildly volatile after the announcement. Down as much as 10-15%, and now sort of closing that. But we shall see. I do think you're correct in that there is a burgeoning crisis developing in commercial real estate, to the extent that there is a significant amount of debt on assets of dubious quality in the work from home era, post-COVID work from home era, that needs refinancing. And many of these assets are currently being marked on books of consequence at substantially elevated prices relative to economic reality, potentially. And that sort of mark-to-market fantasy looks set to be exposed as those loans need to be rolled over and refinanced. And there's a huge slug of it. It's in the hundreds of billions. And that's the big question, 23, 24, 25. You could just look at the sort of refinancing horizon for what needs to get done for loans coming due, again, on properties of relatively dubious quality that before COVID were considered sort of crown jewel, downtown office buildings in major cities and so on. I think there's been a bit of denial in the CRE space. Now, having said that, everybody kind of knows it, so it's kind of common knowledge, and that's always a bit of a red flag too. Like maybe sort of the worst of it has been internalized already by the markets, but there's no question.
I don't think the worst of it's been internalized. From the commercial real estate experts, I'm hearing the exact same stuff that the residential real estate experts were saying in 2005, 6, and 7, that it's not really a bubble. There's only some problems in office space and a little bit in multifamily. I mean, they're explaining in a way very similar to what the residential real estate experts said in the last real estate bubble.
Yeah, subprime is contained. Yeah. I do think that the trend towards remote work it has a very, very strong stickiness factor that many in the real estate community would like to ignore. And I do think, especially in the younger generations, the concept of putting on nice shoes and a sports coat and or other sort of appropriate semi-formal work attire and commuting 45 minutes through the city to an office just to be in an office all day to do work that you could easily do at home is just unappealing. And the businesses that expect that and or insist on that are going to lose in the war for talent. And we're seeing, the sort of hysteresis effect of COVID is pretty pronounced in the sense that people aren't going back to the office, and the realization that you can be productive remotely, and that there are other, side benefits of working from home, including, escaping your commute and being flexible with your time, and frankly, not being distracted by the sort of day-to-day office politics. Those, of course, have to be measured against the negative consequences of not building rapport and being in person with people and team building and so on. But there are ways to circumvent that in the internet era. And many of my best friends are people that I only know remotely via the web and have never met in person. And I care, in many instances, just as much about them as I do people that I see in my daily life. And so it is a fascinating cultural, social, economic, real disruption. And it is certainly plausible to me that commercial real estate would be an early victim of that.
Well, I think it's a culmination of factors here, and it looks like the pin in the bubble is the higher interest rates, but you also have all the other factors you described. I just want to talk about financing cash flow projections. So if you're a commercial real estate investor or a residential real estate investor, your investments are done on a Microsoft Excel spreadsheet with what the interest rates are, what you think your rents are going to be. You're projecting out these cash flows, the occupancy rates, if you're a commercial real estate investor. So all that math, whether it's the occupancy rates collapsing, you're not going to be able to pass on higher rent, because if it's a retail company or a large corporation, they're reducing the amount of commercial real estate office space they need downtown, or they're moving to a cheaper location outside the major cities. So all that math there, especially with higher interest rates, it just doesn't work anymore.
Yeah, and I would say it matters if you're talking about money already in or new money potentially going in, because new money potentially going in, real estate ultimately is a gamble on interest rates, as you said. And imagine that you believe the Fed is going to pivot, and you're seeing all these distressed, assets in the real estate market, and you would happen to have some unique local knowledge and a belief. Well, new money in might be in a great position, whereas old money in might be pretty dead. And that's sort of, I guess, investing 101, I suppose. But the consequences of old money being marked properly and how that would manifest through the financial system is certainly an important question.
Yeah, it's interest rates and also rent projections. So are your rents going to be high enough to where you can pay off your mortgage debt and also have free cash flow there to pocket as well? So in this environment, though, we're just seeing stories about restaurants and retail. They're reducing the amount of locations. A lot of large corporations are either reducing the amount of commercial office space downtown, or they want to move outside the major cities, or they're reducing, they're having more of their workers work from home. So that number is not going to mean higher rents downtown for all this office space. So I think we're starting to see this in the headlines, that some of these commercial real estate developers are getting in trouble, whether it's DC, Houston, San Francisco, and they're starting to sell these assets now for cash, or they're closing up their funds to where they don't want the investors leaving.
Yeah, we're seeing obviously the gating of Blackstone's REIT, and I saw a headline with KKR doing a similar thing. And so ultimately, of course, these are all sophisticated investors. And again, like back to that whole concept of old money, dead money, new money, good money, there will be no shortage of people looking to take advantage of it, which of course ultimately is what makes for a market. But it is a fast. It does. I always try to make sure that I don't fall into the trap of pattern recognition too thoroughly. But as you mentioned earlier, it certainly does have an echo to the residential real estate market pre financial crisis. So a bit of denialism, a bit of mark to market, sleight of hand, and a sort of ongoing insistence that all of this is contained. Now, just because it feels like a pattern doesn't mean that it's going to repeat itself in the same way, but it is certainly a risk that is worth keeping a very close eye on.
Yeah, I agree. That's a good point. I mean, there was also trillions in derivatives, mortgage-backed securities that were also tied to falling residential real estate prices. So I don't know if there's as many derivatives for commercial real estate as there was for mortgage-backed securities for residential real estate back in the last real estate bubble in 2007, 8, and 9.
Well, this also then brings into the further complication of the entire sort of shadow banking industry. And Grant Williams put out a great Things That Make You Go piece a week ago on this topic, which is really eye-opening, just the size of it and the contagion possibility. And so you can imagine, just to give you a hypothetical, that a major shadow banking player that has tentacles into the sort of regulated banking system, but also has significant exposure to CRE, and they suddenly go, get into trouble, there's your contagion transmission into the sort of standard banking system, right? And the shadow banking system is huge. It's really an eye-opening piece to read. And so, yeah, I mean, to the extent that, the analogy, again, to go back to 0809 of subprime being contained, here, CRE might be contained, except for a major player in a shadow banking system goes under, and then their counterparty to God knows who else, and then they have struggles, and then there's a panic, and people pull their money from various, funding activities, which then leads to knock-on effects and so on. And the big fear about the shadow banking sector, of course, is it's unregulated. And so it's interesting to me, after having read Grant's piece, to see the headline about Janet Yellen, increasing rules for transparency around shadow banking. I don't think this is a coincidence.
I've been listening to interviews with banking experts like Christopher Whalen, and he was talking about that he thinks that this commercial real estate crisis isn't as bad as the residential one, but then he's saying that the regional banks all need to do equity financings, and he's making it like it's going to be fairly easy for them to do. I mean, I just don't see the demand there for a lot of these regional banks to go and do large-scale equity financings. Look what happened when depositor funds were leaving Silicon Valley Bank, and there were rumors that they needed to raise capital, that they had mark-to-market losses and needed to do equity raising, and that basically started accelerating a bank run.
Yeah, that's one of the unfortunate potential negative consequences of this mini crisis that we had, which is the mere act of raising equity capital, given the fact that Silicon Valley Bank basically failed within 48 hours of trying to do so, is now viewed as a panic-inducing negative sign, as opposed to a sort of standard way in which capitalism is supposed to work, right? And so this is the whole issue with, fractional reserve banking, where, the equity stack in the cap structure is so thin by definition, right? Which
also, I think a major problem, Silicon Valley Bank, you had a lot of ESG and tech people, a lot of really affluent people and companies. They had way more than 250,000 in cash at that bank. So they were skirting the FDIC cap there. And so they were playing Russian roulette kind of with the rules. And
there's no question that Silicon Valley Bank was unique. It had a very concentrated and flighty and really a deposit structure that was born out of its own bubble, which is the venture capital private market mania of 2020, 2021, early 2022. But that doesn't mean that the generalization of that lesson, i.e. the act of raising equity capital by a bank is a reason to pull your deposits, doesn't escape beyond the uniqueness of the situation that allowed us to believe that sort of temporary axiom. And so that is, in fact, an example of how subprime isn't contained, right? And so let's just take a step back and make a general statement. If the act of raising capital is considered by CEOs of regional and community banks to be off the table today because they don't want to spook their depositors, what does that mean for the banking system? Like, it's healthy for banks that have suffered some losses to raise equity capital to compensate for those losses. And if they could easily do so without triggering a run, then that would be an investment in the confidence that the investment community has in the leadership of the bank. If that's off the table today as a blanket rule because people don't want to spook their depositors, what does that mean? It's actually a pretty interesting problem to contemplate.
Yeah, it sounds like a vicious cycle. And you mentioned it's because of fractional reserve banking, but also a lot of people have way over 250,000 in cash at these different banks. I think if people are smart, they'll start to read the rules more closely. I've spoken with a lot of people that have over 250,000 in cash at a lot of these banks, and some of them don't even know the FDIC rules.
Yeah, there's no question that institutions, private, nonprofit, public, that have, cash flow management issues that cause them to keep more than the FDIC limits in any particular bank are doing a hard look. And the act of doing that hard look could itself be an example of contagion, right? If you're a small business that has $5 million in cash and you've got payroll to meet and you've got suppliers to pay and cash comes in and cash goes out, but you like to keep a certain buffer just for liquidity reasons and so on. And you may have kept, all of that money at a sort of a local bank. You'd be foolish not to be looking at that as a significant risk to your business today. Like, who wants to get $250,000 out of the $5 million you think you have, and maybe an initial payout and then a claim against the FDIC for the balance that might take you 12 months or 24 months to recoup, and all the while you have to make payroll and you have to pay rent and you have to pay back various lines of credit, and so it is, I think, a potentially serious risk, which is why, of course, we wrote the piece Regional Fallout and tried to articulate that for our readers.
So I agree that normal equity raisings should be accepted by the market, but in this environment, I don't think they're going to be as easily accepted as a lot of people think they are for these regional banks. So do you think ultimately then, if these regional banks cannot raise capital, they're looking at either bailouts or the larger too big to fail banks, which have plenty of capital and they don't have to market all their losses? They're just going to end up asset stripping, picking and choosing whatever they want from these regional banks, all the quality assets and personnel then.
Well, I'll give you a sort of alternative view, which is all these problems go away when interest rates fall, because the mark-to-market losses suddenly become gains if interest rates go down enough, right? And so again, back to my original thesis, when having to choose between the abyss and changing course, the Fed will change course. And so this is the sort of infamous pivot that everybody is pointing to, and that hasn't occurred yet. But if the Fed is looking at, a wave of bank failures that ultimately threatens the economy, it'd be interesting to see. This is why, of course, the market is perennially calling the Fed's bluff and pricing in lower interest rates than the Fed is signaling, and we'll see at the next meeting. Again, like Jerome Powell has clearly articulated that he intends to stay higher for longer, and the market has continuously doubted him, and the market has been continuously very wrong in this regard. And so we have no view as to whether the Fed will ultimately pivot, but there is no question that this problem goes away with lower interest rates, right? All these,
Well, I think the damage can't be fully reversed though. So I mean, like the banks are still going to the regional banks have to market their losses if they need to do equity capital raises. So I think the commercial real estate bubble is just starting. I think we're in the first or second inning of the U.S. commercial real estate bubble. So we haven't seen any type of major failures or problems in terms of large scale regional banks larger than Silicon Valley Bank or a bunch of different banks failing. I mean, we had last week, we had Brookfield, which is a DC commercial real estate developer. I think they defaulted on about 160 million of their bonds, but nothing yet for tens of billions of dollars.
Yeah. But let me be very clear. If interest rates went to zero tomorrow, these banks could sell those assets for a gain and not have to mark a loss and would keep their equity cushion. And the capacity for commercial real estate to roll those loans over on reasonable terms, to kick the can down the road, so to speak, would be much higher than it is with rates at 4 or 5% like they are today. And so that's my point, which is all of the sort of stresses that come from the meteoric rise in interest rates, by definition, get alleviated if interest rates were to collapse again. And depending on the size of the potential contagion and abyss that the Fed would be looking into, it's not clear to me that they wouldn't decide to just let inflation run hot. That's the sort of the easiest way for politically oriented financial leaders to, private public sector financial leaders to private, the government. That's the easiest way for them to, quote, default on their debt, is to just inflate it away. And so, as much as Powell is talking tough on inflation, I guess the real question is, at what level of pain would he have to pivot?
Especially when interest payments on the national debt at these interest rates, because a lot of US Treasury debt has to be refinanced soon. The interest payments on the debt are almost at $900 billion per year.
Yeah, it's not like we took the opportunity of zero interest rate environments to extend the duration of our debt profile, right? And so that's a whole other, can of worms for sure.
So I want to transition now to energy for the rest of the interview. What are your thoughts on global oil inventories and if Chinese oil demand comes back online?
Yeah, I think it's very clear. We wrote a piece on this as well called it was called Price Discoveries. No, sorry, that was the Bitcoin piece. We wrote a piece on Saudi Arabia and the consequences of this OPEC Plus deal, which really to us signal the fact that Saudi Arabia is going in its own direction here. And the piece was called Uniting States. Yeah, this is China taking advantage of our pullout from the Middle East to sort of unify the region and convince them that perhaps the U.S. isn't their friend. And so long term, I think the price of oil, which as we're talking is sort of WTI is hovering around $80 a barrel, 79, I guess, as we're talking. The long-term impact on the price of oil, it comes down to several things, of course, which, as you articulated, includes, most importantly, the demand rebound from China post-COVID reopening, but it also includes U.S. production, U.S. demand, and the unity of OPEC. And, historically, whenever OPEC and OPEC Plus, I guess when I say OPEC, I mean including Russia and the other states, historically, when OPEC has had market power, they've tended to use it, and they have a desire for higher oil prices. I think sort of their internal put is probably $75. Below that, they'll act, and we saw that. When oil was drifting below that number, they cut their production targets by 1.5 million barrels a day on a Sunday, much to the surprise of the Biden administration. And in the piece, United States, we talked about the real consequences of Saudi Arabia going its own way. And all the evidence is there that they are. Now, historically, how long that will last remains to be seen. But it is, we think, a potential sort of geopolitical earthquake that is being minimized in the mainstream media, at least in the U.S.
I also think that we're looking at a oil price shock in the next 12, 18, 24 months, similar to the cycle that played out in 2020 and 2021. Because if Chinese oil demand comes back online, we're also seeing supply side problems. Now, the Saudi oil minister said in the last couple of months that if Chinese oil demand returns to 2019 levels, the Saudis don't have any more spare capacity. The other major problem with that is, and I've interviewed a lot of people on this, I've been reading comments from the CEO of Pioneer Natural Resources, many other experts that operate out of the shale patch in the Permian Basin. It's really looking, Doomberg, like the Permian that the Permian Basin oil production either has peaked or it's very close to peaking, and the amount of capex required to maintain that oil production level is going to be sky high. So it's looking like the major growth driver for global oil supply growth for the U.S. and for the globe, the last really since 2008, that one's peaking.
Yeah, I was interested to hear the CEO of Pioneer on, I believe it was Robert Bryce's podcast, Power Hungry podcast. And he talked about the constraints to increasing growth in the Permian Basin. We wrote about this a little bit in a piece called Guilt by Association, where we talked about the main constraint, which he highlighted, which was validating to our thesis, is in fact natural gas offtake capacity, because in the Permian Basin, which is really the source of much of the growth in oil production in the world, really. Lou Gehrig was on Decouple, which is another great podcast episode, and he said, interesting turn of phrase, which is all of the world's oil growth comes out of 6 counties in Texas, which was his reference to the Permian. They have a lot of associated natural gas with that oil production, and they have no place to put it. And at the same time that natural gas is trading for $8-9 in California and traded for as much as $100 per million BTU in Europe within a year ago, they can't give it away in the Permian Basin. And in fact, between that and sand supply and water management, but natural gas was highlighted by the CEO of Pioneer as being one of the major constraints. Now, on that podcast, at least, he did say that he thought the U.S. could grow 1.5 million barrels more from here over the next 18 months, but then that would be the top. Calling the top in U.S. oil production is a challenge, of course, but and he has reason to imply bullishness on production to the market, because there are, of course, concurrently rumors about Exxon potentially buying Pioneer, and he would want to put a good face on his company's potential to produce in the next 18 months. But
well, if he's talking about production growth, I'd want to know what the capex bill would be to grow that production, because is it tens of billions? Is it hundreds of billions? I mean, that's not in order to maintain production. They've just gotten so efficient, though, at these octopus drilling pads in the shale patch now. They pulled a lot of the production forward a lot. So I use the analogy that basically it was the octopus drilling pads were like just sticking more straws in the ground and pulling the oil out faster.
Yeah, he goes into that a bit, and his view is Permian in particular still has a pretty interesting and robust set of tier 1 inventory drilling sites to work its way through. Once those are depleted, of course, all bets are off. But there is always this challenge of betting against technology innovation, and we should give significant credit to the operators in the shale patch, both for oil and gas. Like, boy, if you look back a decade ago, what they've been able to pull off is pretty remarkable. And people have been calling the top in U.S. shale for many, many years. Now, it is just undeniable, looking at the data, that we have not yet recouped the pre-COVID highs of 13 million barrels a day for the U.S. as sort of overall oil production, and we seem to be struggling to shoot past 12 million barrels a day right now. And that, of course, coincidentally is why Biden was releasing 1 million barrels a day last year for much of last year heading into the election from the Strategic Petroleum Reserve to sort of offset that and to cushion that delta. So we shall see. It is no great, it's quite ironic to us, of course, that the main opponents of oil and gas are in fact feeding into sort of the market power of OPEC, and they intend to use it. To circle back to how we started.
I think if the experts, and other than the Pioneer Natural Resources CEO, a lot of the other people I've talked to think that the Permian Basin is either peaked or close to, and the amount of capex required to maintain those oil production levels are insanely high. But there's not a lot of other shale patches that are going to have efficient growth. I know Argentina is talking about doubling their oil production, but that's only to 500,000 barrels per day over the next 5 years. And 500,000 barrels per day for the global oil supply is really not that much.
Yeah, I would differentiate between the Permian and the rest of the shale patch. I think if you integrate across shale, U.S. shale growth is becoming more challenging. But if you isolate the Permian, and you could do it on Bloomberg, I can pull up the chart, but the growth is pretty substantial and pretty measurable. It doesn't yet look like it's turning over. The big question, of course, is can it compensate for the decline rates of the other sort of major shale regions in the U.S.?
Do you think that most of the oil supply growth going forward then is going to have to be deep water? So do you think then that U.S. shale oil production just bought the global oil supply a lot of extra time between 2008 and 2019, where they didn't have to bring on as many deep water offshore wells, and that now we're going to have to get back to investing into deep water offshore again?
Yeah, but also traditional oil and gas, like we saw with the Willow project approval by Biden in Alaska. Look, I think Joe Biden understands the problem and understands the vice that he's in, which is a vice of his own making, which is on one side of that vice is the sort of radical anti-fossil fuel environmentalists who are a small but loud component of his political base. And then on the other vice is the political impalpability of high oil and gas prices that manifest in the form of, the price of gasoline at the pump. And so ultimately, when push came to shove, at least, in the context of the Willow project in Alaska, Biden ultimately caved and signed a pretty favorable deal to the oil and gas industry. And I do suspect that would be sort of the standard MO going forward, because he does viscerally understand, at the political level, the importance of low energy prices for the economy and for his political future. Now, that's going to upset, those loud members of the sort of minority part of his coalition, and they're very effective and very loud and spend a lot of money. And so it remains to be seen whether, a Democratic politician or a progressive politician can ever sort of walk that careful line between pretending to care about these things, but ultimately understanding the need to increase U.S. Production of oil and gas.
So U.S. natural gas prices are down substantially in the last 6 months. They're down a lot. They've been cut by over 60%. Do you think that a cheaper U.S. natural gas price gives a relative advantage to U.S. fertilizer producers?
Yeah, so the natural gas price, Henry Hub, is just one regional hub. There are many regions in the U.S. where natural gas is priced, and they have a surprisingly high disparity. As we talked about in the piece, a lot of this glut in the U.S. is driven by the growth of oil production in the Permian and the associated natural gas that comes with it. And if we could build an efficient network of pipelines, the price would equilibrate higher than where Henry Hub is and much lower than it is in California and New England today. And to your specific question, the major producer of fertilizer in the U.S., of course, CF Industries, they're plugged into the U.S. natural gas pipeline, I assume, and they have pretty favorable economics. And so it would certainly favor them. They basically have said in their earnings calls that they capture the spread between, LNG prices and domestic prices in the U.S. because they get to sell their fertilizer at a global price, but they're back integrated into cheap U.S. natural gas. And in many ways, the lack of offtake of this associated gas could potentially constrain U.S. oil production, because ultimately there are a lot, there's a movement to outlaw flaring of it and to minimize U.S. flaring. And literally there are parts today of the Permian Basin where oil producers are burning natural gas in the field because they have no better place to put it. what a waste of a beautiful and low carbon intensity, high energy density molecule. And so this really just shows you just how regional the U.S. natural gas market is. So at the same time that Henry Hub is $2 and the Waha Hub in the Permian Basin is $1 and sometimes negative, natural gas in California was $55 in December and it's still $9 today. And Boston is buying, its natural gas via LNG carriers from Trinidad and Tobago. It's just absurd.
This is because the politicians, bureaucrats, regulators, they won't allow in the U.S. has a very large pipeline network, but they won't allow additional pipelines to move the gas freely to where the
correct
it's needed the most.
That's the issue. It's environmentalists have successfully opposed, litigated against, obstructed, and made expensive incremental pipeline construction. And California, for example, has no capacity to tap into U.S. natural gas production effectively. The SoCal hub, obviously, there's a pipeline there, and that's where they're measuring the price. But by and large, it's not like natural gas from the Permian can find its way to California to assuage, to cheapen the cost of natural gas for California residents. And so it, in fact, is all being exported. And so there is some relief in pipeline offtake scheduled for the Permian in the next 18 months, but most of that is going to allow the natural gas in the Permian to be piped to our LNG export terminals so that we can increase our exports. If you look at the amount of gas that we're flaring and or exporting, we could displace a big chunk of our coal use. For example, in the piece we talked about, I think our coal use amounts to relatively close to 23 billion cubic feet per day of natural gas on an energy equivalent basis. And between flaring and exporting, we're going to be up to 20 BCF. And so here we are burning coal to produce natural gas when we have the cleanest of the fossil fuels in huge abundance. And for lack of pipeline, because of environmental obstruction, we're either sending it to the rest of the world or flaring it. It's really, really an amazing situation.
I thought by 2018 or 2019, a lot of U.S. electricity power plants had a lot of the electrical utilities, had switched over from coal to natural gas. So that wasn't the case then?
The total amount, the anticipated demand for coal in the U.S., which is all stats that we pulled from the EIA in the piece, is the equivalent of 23 BCFs of natural gas per day. And just to give you some rough numbers, I think when you combine associated gas and dry gas, U.S. total production is somewhere around, and don't quote me, but 110 BCF, just to give you like a ballpark. And so with a quarter of our natural gas production today, we could, in theory, offset our coal burning. But when we export it instead, via our LNG export terminals, which are growing, we are effectively maintaining the need to burn coal to keep the grid stable in the U.S. The U.S. is still burning an enormous amount of coal, and I'll pull up the exact number here while I'm talking to you, but it is really quite fascinating when you just take sort of the high-level view of it. So according to the latest short-term energy outlook by the U.S. EIA, we're set to burn 441 million short tons of coal in 2023, which is, again, by our math, 23 BCF per day of natural gas, and which is less than a quarter of our total production, but roughly the amount that we're going to export plus burn in the years ahead.
So if you're an electrical utility company, you can't take advantage of these cheaper U.S. natural gas prices. So you can't get on the phone to a natural gas producer that has a storage tank and say, I need the gas piped over here, or we're going to send some type of tanker. You can't negotiate a long-term contract price around these prices then?
Well, first of all, if you have a plant that burns coal, it's not like it's not trivial to retrofit it to burn natural gas. These aren't the same technologies, right? And then if you don't have access to it via pipeline, it's not an option to you. And then building a new power plant in a region that is connected via pipeline comes with its own set of challenges, and so on. And so, yeah, I don't think it's obviously, since we're exporting as much as we are and we're still burning that much coal, it's not like it's a trivial thing.
So again, this is not a free market problem. It sounds like the pipelines and all the other stuff are being blocked to prevent the electrical utilities and the other markets from getting access to the natural gas they need at market prices.
Yeah, the US market for natural gas, and by extension, the global market for natural gas, is so far from being able to arbitrage regional prices that it is really an amazing market to study and to understand. And and it's counterintuitive. But literally, OPEC's production cut drove US natural gas prices down because OPEC's production cut meant oil was more valuable, which meant it was more valuable for people in the Permian Basin to produce oil, which means they're going to produce even more associated natural gas, which is going to increase the glut of natural gas in those regions. OPEC's production cut did nothing to the price of natural gas in California because they are not connected to oil producers who also produce natural gas. And it's so hyper-regional. And the simplicity of just having a natural gas pipeline that the entire country could benefit from this potential arbitrage opportunity, that simplicity is lost on our political leaders today. And our environmental leaders certainly aren't interested in creating such an efficient market.
And these, the volatility in the natural gas price, the natural gas producers, they're going to be cutting back drastically on the natural gas wells they drill. So we're going to have supply problems then in the coming quarters because they're not going to reinvest back into new natural gas wells. They're going to actually be taking supply offline. So the price may stay low for another couple of quarters, and then there's going to be a supply problem, and then we're going to get a spike again. So it's going to be a roller coaster with volatility in prices.
I would differentiate between wet gas and dry gas, though. Wet gas is associated gas where people are predominantly performing an activity to produce oil and they get gas as a byproduct, versus pure play dry gas producers, say in the Marcellus, in Appalachia. They might be less inclined to drill natural gas for natural gas's sake, but ever increasing prices of oil are going to cause producers in the Permian, for example, to be bullish on production, regardless of the price of natural gas. How those two flows net out, of course, is what will determine the price.
Well, there's still a lot of profitable long-term liquefied natural gas export contracts. So the Cheniere Energies of the world, Tourmaline also in Canada, because Vancouver has a new liquefied natural gas export facility coming online soon. So it looks like those companies are still in good shape, but the actual producers of the natural gas are the ones in the Permian Basin and others. Their revenues on the natural gas side are going to be collapsing.
Yeah, again, these are all sort of company-to-company contract situations. What an LNG exporter is paying for their natural gas and what they get to charge it as they export it can sometimes be significantly different than the benchmark price traded on a futures market. But ultimately, if you can export your natural gas, you're in good shape. And if you are sitting in the Permian with no place to put it, producing more of it doesn't help you. And in fact, it could hurt you, which is why we're seeing some people flare it, some people vent it, much to the chagrin of the very environmentalists who have opposed the construction of or expansion of pipelines that are necessary in order to avoid those unfortunate outcomes.
So as we wrap up the interview, are we going to see a lot of food shortages and other supply problems with a lot of these crops? Because the farmers over the last 2 years, when fertilizer prices are high, they didn't replant, they didn't order fertilizer. So can we expect more headlines going forward, like a global rice shortage, problems with wheat crops? Are we going to see a lot of that because farmers did not order the fertilizer and do normal planting seasons?
I would say that crisis has abated with the European energy crisis and their fortunate bout of warm weather for the winter, which sort of thankfully shaved the edge off of some of the worst case scenario risk. If I'm looking at the price of ammonia, the U.S. Tampa ammonia spot price per ton is down, 75% from the highs of the crisis a year ago. And so to the extent that global energy prices, including natural gas, which is, of course, is an important feedstock into the fertilizer sector, those prices have come down a lot for the reasons we talked about. That comes to the benefit of fertilizer. And I do think that, the prospect of a true crisis was diminished, thankfully, because of the sort of the whims of Gaia and the warm winter that Europe was able to experience this year. Now, that doesn't mean that European insistence on conflating good luck with good strategy means that they're setting themselves up for a potential disastrous upcoming winter as they shut down nuclear plants and so on. But it for now, if you just look at the market price, a fertilizer, they've come down substantially from the peak, which is a good news, something that we should all cheer. And even the fertilizer index itself, is down. It looks like at least 50, 60% from the highs as well.
But we're starting to see these article headlines about global rice shortages and others. So you don't think that that's connected to fertilizer then?
I think rice is a unique market. I've seen those same headlines. Haven't really dug into the genesis of the rice crisis, but if you look at wheat and corn and soybeans, we're not seeing similar signals of crisis. Now, don't get me wrong. Rice is way more important to way more people than most other commodities, and so we've seen those headlines. Can't say that I fully understand the direct tie to natural gas.
Thank you. So you expect then a lot more volatility based on natural gas prices, oil prices. Do you think we need to invest trillions more to fix the supply problems?
I think a lot of this depends on how the relationship between the U.S. and China shakes out in the next 12 to 18 months. When you say, quote, supply problems, I hear sort of onshoring, reshoring, which are trends that are ongoing for sure as tensions between China and the U.S. Heat up over Taiwan in particular. And so when I think supply chain, I think commodity supply chain, and then I think advanced, chips and sort of advanced materials that also make the economy run. And those are sort of two separate markets with two different sets of risks. I do think that the U.S. The U.S. military in particular is very interested in at least reshoring and potentially onshoring as many critical goods as they can. I don't think even in sort of a global commodity famine, food type situation, the U.S. or NAFTA or North America is in any great danger given our bountiful supply of the critical materials that we need. We would very quickly sort of limit exports in such a situation before we would short ourselves of those goods. So I think it depends what sector you're talking about and which part of the world you currently live in.
Yeah, by global supply problems, I meant long term that there could be an oil supply shock if Permian Basin oil production falls and the Saudis and OPEC do production cuts and Chinese oil demand comes back online. I just see a train wreck 12 to 24 months from now where there's not as much supply. And so we're looking at oil prices above $100 a barrel, significantly higher than that in the next 12 to 24 months if things play out the way I think they could with Chinese oil demand coming back online, the Permian Basin peaking, and OPEC maybe even cutting supply further.
Yeah, we would be structurally bullish on oil. We would be less concerned about Permian peaking than perhaps you are, but we would also be more concerned about a deteriorating U.S.-Saudi relationship than the market currently believes. So maybe those two things wash themselves out. If you pushed us to go long or short oil at these prices, we would be long. That's not investment advice, and we have no meaningful investments in that regard. But if pressed, I would say that the risk is certainly to the upside rather than the downside from here.
And a higher oil price would be inflationary for a lot of cost of goods sold and a lot of items. Yep. I don't know if the consumer price index will reflect that, though.
Yeah, but that's going to be offset against a lot of decreasing value of real estate.
Does the consumer price index count that?
I'm sure, whatever they need to count to make it look better than it is, I'm sure is what they'll end up doing.
Yeah, so I'm definitely keeping my eye on what the Fed does with interest rates and what's going to happen with commercial real estate. I mean, the banking experts are making it like this crisis is contained. The regional banks are going to be able, if they need to do equity raises, are going to easily be able to do equity raises. I'm just very skeptical about some of the comments that are the stuff that I'm hearing from banking experts. I mean, these people are just making a lot of kind of ridiculous assumptions that if the loan book is 50 or 60%, they're telling people in public that the banks should not make too many loans to one specific industry. And yet here we have all these regional banks that have 50, 60, 70% of their loan book in commercial real estate. They're making it like equity raises are going to be done easily. A lot of the stuff just doesn't make any sense in a fractional reserve banking environment. And look what happened with Silicon Valley Bank when they tried to raise capital.
Yeah. And look, as we're closing up this interview, First Republic is down 20% in after hours. So we shall see. keep an eye on FRC as sort of a proxy here, I think, because
Well,
ultimately the Fed drew a line in the sand, and when they bailed out Silicon Valley Bank depositors, in our view, we also heard that they just weren't going to let First Republic or Western Alliance or PacWest fail, and we'll see if the market challenges that belief here soon.
Well, rather than one specific bank, the listeners can also look at the regional bank ETF KRE. So that chart on that one is just very, very ugly.
Yeah, indeed. It's funny because Twitter trolls being what they are, when we published our piece, Regional Fallout, somebody retweeted and said, "Time to go long KRE," as though we were a contra on the matter. And it's all I can do to not pull up the chart and reply, "How's that trade going for you?" But one of our rules is we don't reply to trolls, so I'll resist the temptation to do so.
Well, there will be rallies. I mean, there were rallies before Bear Stearns crashed. There were rallies before Lehman Brothers went bankrupt. So there's always some type of rallies because the bank itself either gets some capital or is able to sell some assets for some cash. So there's always rallies and stuff like that. I just think that it's the trend for problems with regional banks. I think the commercial real estate problems are just starting. So for a baseball analogy, I think we're only in the first inning for commercial real estate problems. I don't know if it's going to take 3 months, 6 months, 9 months, 12 months, but all these headlines in all these major metro areas, major cities, none of the things that are coming out about the headlines are positive, I would say, for commercial real estate.
Indeed.